Don't let investing become the biggest mistake of your life. Greetings from FortuneCraft, ladies and gentlemen. If you've already embarked on your investment journey, or are planning to make your money generate more money, you absolutely must watch this video to the end. I'll share with you a way to make money before investing, especially in the context of an economic downturn that's gradually revealing itself. If you suffer losses and get stuck, what should you do? In fact, I've always been a positive thinker. When the economy was booming, many new investors could simply close their eyes, buy stocks or Bitcoin, and still make a profit. I was genuinely happy for them. But the problem is, unless the market stays in a perpetual uptrend, when a recession hits, the money they earned over the past few years could vanish overnight. I'm not trying to scare anyone, but lately, I've noticed too many unstable factors emerging. Can those who've tasted the sweetness of the market handle its bitterness? A true investor doesn't just know how to make money in good times. Whether the market goes up or down, they can still achieve stable profits, sometimes even more than usual. So, how do you become a skilled investor? The book Rich Dad, Poor Dad taught us that you must have an investment plan. Sounds cliché, right? That's why many people don't understand it and think it's just empty talk. But if you can do it, it becomes a fundamental truth. Let me explain further. A skilled investor is like a general, and an investment plan is like a strategy in Sun Tzu's Art of War. It all revolves around the concept of using strength to defeat weakness. If I have 1,000,000 soldiers today, and you only have 10,000, I could beat you with my eyes closed. This is the principle of high probability. The goal of investing is to seek opportunities with a high chance of success, ensuring that before you invest, you're already confident of winning. Even if the market crashes or a financial crisis hits, it won't affect you. If this video is helpful to you, please give it a like. I want to emphasize that this channel focuses on sharing the mindset needed to become an entrepreneur, a business owner, and a wealthy individual. If you don't want to miss out on this valuable information, connect with me, subscribe to the channel, and turn on notifications. Have you ever wondered why the world's top billionaires, like Jeff Bezos of Amazon, only earn an annual salary of about $80,000, or why Elon Musk of Tesla doesn't even take a salary, yet their income per second surpasses most people's yearly earnings? Here's a truth you need to know. In the US and many other countries, the government requires employees and business owners to contribute a portion of their monthly salary to retirement funds. This money is handed over to fund managers, giant financial institutions, to manage and invest. When these entities control massive sums from global retirement funds, their investment decisions influence the prices of stocks, bonds, and other financial markets. This is why people like Bezos and Musk keep getting richer. They own real assets, millions, even tens of millions of Amazon and Tesla shares. When you get your monthly paycheck, a portion of it is deducted and indirectly flows into the pockets of these billionaires. And it's not just in the US. Any country with a retirement plan operates similarly. Even if you don't work for Amazon, you're still enriching these billionaires. This is also why, despite financial crises, the stock market always trends upward in the long term, because as long as people work, money keeps flowing into it, mandatorily. So, if you don't learn to invest properly and own real assets, you'll always be exploited. But what's the true essence of investing? I've previously shared with you about investing in real estate, but people always ask, what if property prices drop? First, if you look at housing prices in big cities, they're still rising. Second, those asking this question are actually speculating, yet they want to discuss investing with me. Though both involve buying a house, we're doing entirely different things. And the problem is, you think you're doing the same thing as me. That's the biggest mistake. Buying low and selling high to profit from price differences is trading. It's a way to start a business from scratch. But it's not the goal of investing. If you use money to profit from price gaps, you're speculating. A true investor pursues two words: cash flow. In 2008, during the financial crisis, many people, including my family, bought homes. I was still young then, and saw them cry when they had to sell their house. When I grew up, I asked why they sold. They helplessly replied, there was no other choice. We had to cut our losses and sell. During that recession, even the monthly mortgage payments were unaffordable. If they didn't sell, they wouldn't even have money for food. But a relative of mine was different. When house prices dropped by more than half, he didn't rush to sell. He even had money to buy more. Now each of his properties has increased in value tenfold. If I were his son, I probably wouldn't need to work. Just living off his wealth would be enough. When my parents heard this, they got upset. Who would sell a house if they had money? I didn't say anything more, but kept thinking, why didn't my parents have money back then? While my relative did. They were both workers, doing the same manual labor. Was my relative more hard-working than my dad? From what I know, my dad actually earned more than him back then. It wasn't until I read Rich Dad, Poor Dad that I understood the difference between them boiled down to two words: cash flow. If you understand from the start that the world's richest people don't make money from salaries, but from steady cash flow pouring into their pockets, monthly from workers' retirement funds, the picture becomes clearer. My parents bought a house because prices were rising. They bought to live in it, and when prices went up, they sold to upgrade to a bigger one. But my relative was different. He rented out his house and rented a cheaper one to live in. As house prices rose each year, so did his rental income. By the time the crisis hit, his rental income was enough to cover his mortgage payments. Before the financial crisis, when the economy was still strong, he negotiated with his tenants. Normally, rent is $2,000 a month, but if you pay a year in advance, I'll discount it by 10%. Pay 2 years up front, and I'll reduce it by 15%. This way, he collected a large sum of rent up front. When the crisis hit, he didn't care if house prices dropped because he could still pay the bank. While others worried about credit scores and financial pressure, he borrowed more from the bank to buy additional properties. Just a year later, prices recovered. So who won and who lost? Those with steady cash flow win, those without lose. Is real estate the only way to generate cash flow? Rich Dad Poor Dad teaches that if you're an employee or freelancer, you need to move to the level of a business owner or investor. But becoming a true investor isn't simple. You need capital. Without money, how can you buy a house? If you don't want to move every year because rent keeps rising, if you don't want to squeeze onto buses or subways, if you don't want to live like a machine, working daily with income that doesn't match your effort, you must build assets that produce long-term passive cash flow. In other words, even when you're sleeping, traveling, or doing what you love, Even during a financial crisis, you don't need to worry about money. Steady cash flow is like the highest level of strategy in warfare. Today you bring 10,000 soldiers, and I bring 10,000. We fight fiercely, and you think we're evenly matched, about to destroy each other. But then 10,000 of my reinforcements arrive. Does the battle even need to continue? My sheer momentum alone would terrify you into defeat. The game was over before you realized it. Before engaging you, I'd already calculated your troop numbers and secured reinforcements from other nations. Studying warfare isn't about being like Shang Yu, defeating tens of thousands with just a few thousand an exception. That's celebrated for generations. What we should learn is Hong Shang's strategy of ants devouring an elephant, where even the biggest can be brought down. This is a high probability strategy. Similarly, investing must rely on high probability. If a financial crisis hits and house prices drop, does it affect me? No. I don't make money from price differences. I earn from cash flow. So, in the end, it's all about who has steady cash flow. War isn't chess. It's Go. One person can't forever influence a group, but a group can certainly impact an individual. In battle, the winner is the one who concentrates superior forces. Only when my troops outnumber yours by at least 5 times do I engage. In the investment market, there are winners and losers, and the deciding factor is cash flow. If you're out of cards, while I still have plenty, how can you keep playing? Capital determines the outcome. This principle never changes. But remember, don't gamble. Let me offer a theory. If you go to a casino in Macau and play a game like Sickable, doubling your bet each time you lose. First round, you bet $50. If you lose, you're down $50. No big deal. Second round, you bet $100. If you win, you get $200. Subtract the $100 bet and the $50 lost earlier, and you're up $50. You keep rolling with that profit. If you lose, you double again. $200 for the third round, $400 for the fourth, $800 for the fifth. If you win on the fourth round, after deducting all prior losses, you still profit $50. But if you lose again, the fifth round is $1,600, the sixth is $3,200. What's the problem? Each win nets you just $50. But losses grow exponentially. Some say, with infinite capital, you'd always win. Lose 100 times, win once, and you'd recover everything. Plus 50. But the issue is, you'd need to bet billions, and the casino probably wouldn't let you. Theoretically, with steady cash flow and capital, you could always make money. But the question is, during a financial crisis, should you try to catch the bottom? Many say during the 2008 crisis, when the world panicked, Wall Street's oracle Warren Buffett boldly bought stocks like Bank of America and his beloved chocolate company, million in profits. 5 years later, that's why people praise his classic strategy and say we should follow him to buy the dip. When I first studied stocks, I thought the same, but my university professor pointed out a flaw. If you buy a stock today and it drops, you think it's cheap. Should you buy more? But if it keeps falling for a year, even more drastically, would you dare keep buying? Back then, all my friends lost money, even my parents. They said, the market's down due to a trend. All stocks are affected. Have faith. It's undervalued. So buy more. But what happened? Initially, if the stock dropped $1,000, after buying more, A $1 drop meant a $2,000 loss because I'd increased my position and leverage. When it kept falling and I ran out of capital, what could I do? After reflecting, I realized two key things. First, when the whole market is trending down, trying to buy is like swimming against the current. If my goal is price difference profits, I should buy when prices are rising, not falling. I don't need to buy at the absolute bottom. If the lowest price is $50, but I buy at $100 and it rises to $100, I still profit. I might have paid more, but I still made money. Plus, I only enter when the uptrend is confirmed. It might take 6 months to recover from the bottom, but if I buy after the trend confirms, I can make 5 to 6% in just 2-3 days. So, between bottom fishing in a bear market and trading with the trend in a bull market, which is more effective and safer, I choose the latter. Second, Buffett succeeds at bottom fishing not because he's riskier than others, but because he has steady cash flow. Many see Buffett as an investor, but as I've said in another video, he's really an entrepreneur. His company is an asset generating stable cash flow. If you invest in his fund today, whether the market rises or falls, you still pay him management fees, his steady monthly profit. If you run a successful business with over $100 million in annual revenue, investing a few tens of millions isn't a big deal. If you lose, you can cover it with hundreds of millions more from your business. Lose another $100 million, take another $100 million to offset it. If you only have a few tens of millions and lose it all, you might despair and jump off a building. But with hundreds of millions, losing a few tens of millions just stings a bit. You'll earn it back in a few years. So why is bottom fishing investing for Buffett but gambling for you? 2 words: stability. He's not afraid of losses. One loss could wipe you out. He has reinforcements in battle you're fighting alone.
Got it.
The saddest thing is you're speculating, but learning investment skills. What a paradox. People often don't know what they're really doing. For example, everyone's heard, don't put all your eggs in one basket. But Buffett says, put all your eggs in one basket, and watch it closely. Both address risk diversification. But many think they're the same, when they're totally different. In the stock market, you should listen to Buffett during a downturn. When most stocks fall, instead of spreading yourself thin, focus on one stock with the best chance of early recovery. But for asset allocation, you can't just invest in stocks. True investing isn't about making money. It's about protecting your wealth. The 2008 crisis left many tragedies because people invested in one asset type without a safety net. If war breaks out, your stocks could become worthless. Did you stockpile gold beforehand? If Bitcoin crashes, do you have a business generating steady monthly cash flow? Many ask me, how can I invest without money? If you're just an employee or freelancer, you can't, because you lack capital. Those with hundreds of millions can invest $10 million, but if you only have $10,000 and put in $1,000, that's speculation, not investing. So why do people urge you to learn investing even without money? Because investing protects wealth. But if you have no wealth, what are you protecting? That's why I believe everyone needs a career, not just a job. This career must follow trends for easier success, remain unaffected by financial crises, operate automatically for passive income, and have a low entry barrier. Right now, I see only one model meeting these criteria doing business on YouTube. More people are ditching books for videos. More advertisers are pouring money into YouTube. During a financial crisis, you'll still watch YouTube, right? It's the world's second largest search engine with a massive user base. That means with just a phone and a headset, you can create quality videos and earn long-term passive income from ads. The key is, even if you have no assets and are just scraping by, a recession could wipe you out overnight. Some recession triggers, like geopolitical conflicts, escalating tariffs, or nations clashing, are unpredictable. When tensions rise, they might flex military muscle. Shaking financial markets, natural disasters are another wild card. So, what can we predict? First, track the U.S. 10-year Treasury yield, the most critical gauge of global economic health. Simply put, when the U.S. government borrows from you, promising repayment in 10 years, they pay an interest rate. If more people lend to the U.S., this rate drops, and bond prices rise. This matters because the 10-year Treasury is seen as a safe haven asset. Even if the U.S. defaults, bondholders get paid first. Plus, as the world's top economy with vast global ties, U.S. bankruptcy is unlikely, so people buy these bonds mainly to preserve wealth. Why track the 10-year yield, not the 2-year? Because 10-year bond investors are less optimistic about the long-term economy. As I said, when the yield drops, it means more buying. Does that signal an imminent recession? Not necessarily. Retail investors buying bonds won't shift the yield much. It's the big financial institutions, like hedge funds, that matter. When they buy heavily, the yield plummets, signaling a recession ahead. Now, let's look at history. During crises, like the dot-com bubble 2000, the financial crisis, 2008, the trade war, 2018, and the pandemic, 2020, the 10-year Treasury yield spiked before stocks crashed, then fell faster than the market. It's a simple market manipulation rule. Big institutions lure retail investors in, then dump their bonds, raising yields and crashing bond prices before buying back cheap. Got it? If not, just remember, in a crisis, the 10-year yield rises then falls. History shows this drop after a peak marks the stock market's collapse. I share this to warn speculators in stocks. Watch the 10-year yield closely. If it spikes, then drops sharply, be on high alert. The second signal is the US dollar index DXY, measuring the dollar's strength against other currencies. During major disruptions or disasters, the DXY surges as money flows to the safest haven,
The dollar.
I want to stress, real wealth isn't the money you have. It's how long you can live without working, maintaining your lifestyle with stable passive income. Without cash flow, you're not an investor, not even a speculator. If you buy stocks just hoping they'll rise, with no clear plan, that's not investing. It's gambling. In investing, the key is a long-term vision. Every crisis, stock bubbles or recessions, eventually passes. The question is, can you hold on? Do your finances last until recovery? More importantly, do you have the patience and resilience to push through? It's all a test of endurance. Build assets generating steady cash flow first, then invest surplus funds. Once you've made money, market crashes won't faze you. Time's limited. So, we'll stop here. I share free insights on becoming wealthy, entrepreneurial, and financially free. If you don't want to miss out, subscribe, turn on notifications, and share this video. I wish everyone who liked this video a speedy journey to financial freedom. If you found even one or two useful insights today to improve your life, I'm satisfied. I'm FortuneCraft, and I'll see you in the next video. Goodbye.